Hello everyone, thank you for joining us in the latest of our Navigating the Virus Crisis webinar series. We're just going to wait another 2 minutes. We've got quite a few extra people joining us, so we'll wait until everyone's on board and then we'll get started. Thank you. Okay, excellent. Yes, as I mentioned, thank you very much everyone for joining us in the latest of our series of Navigating the Virus Crisis webinars. We have a quick poll we're going to do to begin with, just looking at getting opinions of everyone who's attending. What is your type of recovery scenario that you think is most likely? I'll be launching that poll very soon. Just before we start, a recording of the webinar will be available to everyone who registered, so you will be able to listen to a repeat of this at your leisure. There is a questions tab at the side of your screen. If you click that, you can type any of your questions that you have, and we'll look to answer those at the end. There'll be plenty of time for questions after we conclude. The important information, as always, this is general advice in nature. We don't know any of your personal circumstances. Always read the product disclosure statement, and we recommend you speak to a financial advisor prior to making any investments. So as I mentioned, we have this poll. I'll quickly launch that. If you could quickly say, so which of the following scenarios do you think is most likely in the recovery? Is it a V shape, a U shape, or an L shape from where you're making your investments? All right, and I would say there it's a resounding U-shaped recovery we're seeing. L shape coming in second, V shape with a lowly 10% of attendees expecting a V-shaped recovery from where we are. So thank you very much for attending on that. Now, hopefully that. Okay, great. And yes, we always like to keep everyone updated with a plethora of content. So David Bassanese, who's here, does our regular newsletter. You can sign up for that. But our website is a huge source of information that we have across all of our fund page, and we're on all social media platforms. So just getting started, my name is Alastair Mills. I look after our portfolio analytics and advisor business sections of our business. I'm joined here by David Bassanese, our chief economist, who many of you I'm sure will know. Today Dave will be giving his update on where we are in the COVID-19 coronavirus, a bit of a market outlook around that, and then I will be touching on some ETF investment ideas which may align with those, but predominantly going to focus on where have we been getting the most inquiries, what are our most popular funds at the moment in the current environment. And with that, I'll pass over to Dave to provide his update.
Thank you very much, Alastair, and great to be with you all again for another one of our updates, the next in our series of regular updates. And as you may know, we're doing these more regularly at the moment, given the huge volatility and uncertainty facing both the economy and the markets. So let me proceed just with the next slide. Really, this is probably a nice summary slide of the state of play of the coronavirus itself across many of the major economies. And so what this is the rate of daily confirmed cases. It's a rolling 7-day average just to smooth the volatility. And as you can see, the good news is most of the major economies are now sort of at their peak rate. So the rate of daily increase in new cases has appeared to peak, certainly in Europe. If you're looking at countries such as Italy, it seems to have come down, although I do note overnight there's a bit of a flare-up just in the latest daily numbers. But if you look at the UK and the US, I mean, it has flattened off, but it hasn't yet started to substantially decline in the way that it has in, say South Korea and most notably China. So we're still waiting on clearer signs of a fall in both the US and the UK. So they're still running at high rates, albeit the acceleration appears to have peaked. You can see also there in Australia, we're probably the good news there is we're probably among the best of the developed countries outside of Asia certainly better than the Europe, better than the US in terms of having tackled this. So we're able to close our borders pretty quickly. We've implemented pretty strict social distancing. It seems to have been fairly well adhered to, and we've really managed to, slow the rate of new infections, which is very good news. New Zealand also, even faster than us. Their rate of infections has dropped right away as well. So far so good in terms of at least the first wave. And as those that have heard of me speak, I mean, the risk with all these, with the virus in particular, is not just the first wave, but potentially a second wave down the track. Whether or not we get enough, whether we're prepared for a potential second wave down the track. This is another slide I thought I'd share with you, and I thought it's a good summary of really, if we just go to the next one there, and what it is on the x-axis is the so-called reproduction rates. It's the number of people that in a sickness or an illness or a disease. Now, if you get the disease, what's the average number of people that you pass it on to? How infectious is that disease versus the fatality rate on the y-axis? And as you can see, COVID-19 at the moment, the best guess is it has a reproduction rate of around about 2 to 3. So if someone gets it on average, assuming nothing was done, assuming there was no lockdowns, and we were freely walking around the place, you'd get, around 2.5 people would be infected, which is up there with the common cold, up there with the swine flu, certainly up there with the Spanish flu. And the challenge has been that it's highly contagious, or relatively contagious, not as bad as, say, chickenpox or the measles, but nonetheless, in terms of influenzas, fairly contagious, and the death rate by the best estimates is around about 1%. It does vary highly by city and by country, but on average, the experts still think that death rate is around about 1%, which is notably higher than the seasonal flu and even the swine flu that sort of swept through the world back in 2009. And really, almost on a par. The Spanish flu was worse back in 1918, about 2%. But nonetheless, certainly higher than it's worse than the flu, it's worse than the swine flu. And that's why it's such a challenging influenza to be facing, and that it, left to its own devices, it can spread widely, and it's bad enough that it can flood the hospital systems and lead to a lot of unnecessary deaths if we were just to let it to run right through the country. And again, that's what the best estimates in terms of the scientists are suggesting. Now, so as a result, to deal with the influx, we've had the lockdowns around the world. They're slowly starting to lift. I mean, in the US, they haven't lifted yet. They're still talking about it. Some countries in Europe have started to lift slowly, Austria being one, Denmark another, Italy, again, Spain, still talking about it, but nothing as yet. And the economic, and I'll just share with you some of the economic update in terms of what this is doing to some of the major economies. The next slide is the blue line there is from the Federal Reserve Bank of New York, and what it shows is that it's a summary of monthly indicators, and it has a pretty good sort of indication of what GDP might do in the quarter. And as you can see, it's had an almighty decline as of in the early stages of April, sort of much weaker than we saw even during the GFC back in 08-09. And so economists now are thinking that Q2's, the June quarter GDP number, could be as down like 5%, 5 to 7% in the way in which we measure GDP. In the US, they annualize everything, so they take that to the fourth power, and you're looking at something like 25 to 35 percent annualized decline in GDP. So incredibly weak GDP in the June quarter. But again, the markets at this stage are sort of looking through that, and they're kind of counting on this quick recovery in Q3. And this is where I think the weakness of Q2 is now a given. Markets aren't really even noticing that data anymore. It's really when we learn more about Q3 and the speed of the rebound, and that's where the markets will face their biggest test. Some other indicators, just on the next one. The green line there is what's called continuing claims. It's a rolling sum of the number of people that have applied for unemployment benefits in the US. And as you can see, that green line, it's a bit hard to see, but compared to past recessions where it got up to around about 4.5, 6 million, it's now at 12 million. And those that follow the markets will have known the last few weeks we can get weekly jobless claims in the US running in the millions, 6 million for a couple of weeks. This week it's expected to drop down to around about 3 million. Still incredibly high, but again, I guess the optimists out there will say, well, the weekly jobless claims number at least appears to have peaked. We're not going to get 6 million new cases every week. That does appear to have peaked, but as you can see, the total number is now running quite high, and it's consistent with the unemployment rate in the US over the next few months hitting probably around 15 to 20%, which is absolutely unbelievable. At the moment, the official measure is still only about 4.5%. So a lot to get through. It's going to be a real challenge for the markets to look through that. But again, it's something economists are certainly prepared for, and it's certainly, I wouldn't be surprised when that number comes in, but it's a question of how the markets react. The other big development, I guess, just certainly in recent days, is the slowdowns, the lockdowns, the people not driving, no airplanes in the sky. You've had a big drop in demand for oil. Most countries, the OPEC announced an oil production cut a couple of weeks ago. It was a relatively small cut. Most experts thought it wouldn't have been enough to overcome the supply glut, and obviously it hasn't been. And so what you saw is the near-term future contract for oil, West Texas Intermediate oil, went negative a couple of days ago. And why did it go negative? Essentially because no one, if you were left holding that contract when it expired, you were expected to take delivery of a swag of oil. And there's basically very few places around the world left where you can store oil, and it'd be hugely costly to store that oil. And so a lot of people that left holding it would not really oil users per se, but more financial investors, and they essentially didn't want to. The only people prepared to hold that contract to the end were basically, facing a negative price to allow for the fact that storage costs would be so high. So very unusual. And again, just to point out that the oil futures curve is very, very steep. So the near-term contracts are very, very low. So oil price is incredibly low because there's a glut of oil. But the markets are still pricing in some recovery in oil prices over the next few months, and as the lockdowns end and growth recovers. So there is a steeper curve, but in the short run, it's very, very low. And Alistair may talk a little bit about what that means for markets a bit later. Just in terms of Australia, another update. This came from the ABS earlier this week. It's a survey they're doing on a weekly basis, and it's asking people, whether they have a job. And basically, the difference between the 1st of March and the 1st of April is about 3% fewer people surveyed now say they have a job. So when you think about it, that probably means the unemployment rate in Australia has already gone from around about 5.5% to about 8.5%. Because of the shutdowns. And so we haven't seen the numbers yet, but it just gives you an order of magnitude. Also, both the Treasury and the RBA are now on record as saying, they do expect the unemployment rate here to hit probably around 10%. And without the wage subsidy that was announced recently, it would have probably hit 15%. So the good news, at least, is it won't hit 15, but it's still likely to hit 10 over the next couple of months. Some of the areas most affected, if you look through the employment numbers, I mean, again, this is typically in recessions historically, it's been the manufacturing sector that's borne the brunt of it. It's the most cyclical area, and services are usually not as volatile. So that sort of, holds up reasonably well. So what's unique about this shock is it's really been, well, all sectors are being affected, but particularly the services sector. So the people business, where any business that involves human interaction has really been hit very, very hard. So retailing, for example, accommodation and food services, real estate services, property transactions. Now in there I've put schools as well. Now schools are yes and no. I mean, schools are still, they're closed, but I mean, most public school teachers haven't lost their jobs, but nonetheless they're in that sort of service area. Gambling, personal health service, all up something like 25%. 20 to 25% of the workforce directly at risk from the shutdowns. Some other updates, the government has not been remiss in coming forward with a lot of, there's so many, I could spend half an hour going through everything that the government has done. I won't really, in the interest of time, not do that, but you can certainly have a look through this with the slides later. But I mean, some of the highlights, I think the more recent one, the $1,500 job keeper payment, basically budgeted to last for 6 months, up to 6 months, and for 6 million people, which is effectively almost half the workforce. So the government's basically made provision to pay half the workforce for a period of 6 months, about $1,500 a week. So that's cost $130 billion. So quite a huge package there. But again, that's the idea behind that is that, or obviously it's a welfare measure to keep people, give people income and basically give people income, because otherwise they would probably just had to go and line up and get unemployment benefits. At least this way they retain attachment to their jobs. And when restrictions do eventually start to lift, the hope is that it would mean that these businesses can restart up somewhat more quickly than would otherwise be the case. So, it's really to encourage a sort of V-shaped recovery in the economy when these restrictions can be lifted, though that's still the big question, when they can be lifted. The RBA and APRA have also done their bit. So, obviously the RBA has cut interest rates to rock bottom level of 0.25%. They won't go any lower than that. That's as low as they can go. But what they have done is also targeted 3-year government bond yields to be no higher than 0.25% as well. So the RBA is basically saying it's prepared to buy as many bonds as needed to ensure that the yield on 3-year government bonds in the market is no more than 0.25%. Now, the beauty of that is it keeps a lid on corporate bond rates as well, because they're all priced off government bond yields. So it's an innovative policy. And I'll say a little bit about it later when I talk about gold, because I think this may be a feature we see from a number of central banks, even as we head into recovery in 2021, so-called yield curve management or keeping a lid on bond yields. And what we may actually find is if more central banks start doing this around the world, they'll be effectively monetizing public debt, because a lot of governments will be issuing a lot of debt given the deficits. And by central banks having putting a ceiling on bond yields, they'll effectively be saying we'll be buying some of that debt to avoid interest rates rising too far too fast. APRA have also eased a lot of eased capital requirements on the banks to encourage lending. There's some pressure on the banks to potentially cut their dividends, but again, there's a lot of mixed evidence on that, because yes, on the one hand, banks are very well capitalised in Australia. It's not clear that they really need to cut their dividends at the moment. And also, I'm sure as many of you listening do rely on bank dividends as an important source of income. So if banks just sort of turned around and cut their dividends or wiped out their dividends, it would be an income loss for many people in retirement, which is probably not that helpful at the moment. Some other developments, you can see that the Federal Reserve also, the balance sheet there, huge, is looking at $6 trillion on the books now in terms of the size of the Federal Reserve balance sheet, dwarfing what they did during the GFC, which is there in the grey area. And again, the Federal Reserve has really stepped up in a big way to support the bond markets in the US. It's buying corporate bonds, it's buying even junk bonds now, buying high yield bonds through ETFs. Not necessarily, I mean, the issue will be what happens when bankruptcies start rolling around, what happens when a lot of companies basically go broke and they default on their bonds. You can't really stop that. I mean, the Fed can buy bonds and stop yield curves blowing out, but it can't really stop defaults. I mean, if a default happens and you're left holding one of those bonds, then, you're going to wear the consequences of that. So the Fed, if all it's trying to do is provide sensible pricing in those markets, ensuring that the yield spreads don't blow out too much, but it won't really be able to stop insolvencies and bankruptcies for some of those bondholders should that happen in the months ahead. Some good news. This chart, this is from the Chinese PMI, and again, so China, as we all know, was first affected by the virus, and it locked down. It's now started to ease those restrictions. So the city of Wuhan, which was the first city affected, they have eased restrictions. There's still a lot of social distancing going on. There's a lot of testing. It's not back to normal, but I mean, it's certainly opened up and people are moving about. Good news at this point is that there's at this stage no evidence of a second wave in a big way, though you do hear mixed reports about the restaurants are still being very, very cautious in how many people can be in them and those sort of things. But if you look at the PMI index in Japan, it has bounced back. China has bounced back. Overall, economic activity is still quite subdued in China, though. That PMI kind of overstates the extent to which things are back to normal. All that's really saying is that compared to conditions in February, a lot more businesses reported marginally, at least marginally better conditions in March. But nonetheless, that's a hopeful sign. Still also, just in terms of the vaccine developments, there's a lot of work going on. Again, I won't go through all the details there, but just to show you something like, many trials going on or experimentation going on and trying to come up with a vaccine. Again, the best guess is that a proper vaccine is still at least 12 to 18 months away. Very complicated, and I guess mixed news on the drug front as well. There's been some drugs that have been touted as potentially not necessarily preventing one from getting the virus, but at least treating some of the symptoms. And some of the reports on those have been somewhat mixed more recently. There's a couple of studies where on one drug that it was some US vets were tested, and more US vets that took the drug died than those that didn't in the control group. So that wasn't too good. There was another study last week where it showed that one of these drugs, everyone that took it in this trial didn't die and they recovered, but it turns out that everybody in that study didn't have the worst symptoms anyway, and probabilistically most would have recovered anyway. So there's no clear evidence that drug had any effect. So again, we're still looking, but no sort of silver bullet on the vaccine front at this stage. Just in terms of the market outlook, I'll just sort of give you an update here. This is the situation with respect to the light blue line is the downturn in the market in the US 2020 so far compared to previous recessions, so US recessions. And as you can see, historically, when you are in recession, and there's no question that the US is in recession, bear markets tend to drag out. They tend to last at least a year or a bit longer. And certainly some of the worst recessions, you've seen ultimate share market declines of around about 50% or so. At the moment, we've had the fastest bear market decline and the fastest, bear market rebound so far. You know, the rebound now, in the US, the market's only down 15, 20% from its lows, which is quite remarkable. But I still think that this is just a bear market rally, and we're probably going to go back down eventually over the next few months and retest those lows. But, you know, you never say never, but I think we're at least due for a decent pullback of the markets. Whether we go through those lows, open-minded, but I mean, I think there'll be an opportunity to buy at better levels than where we are at the moment, that's for sure. Now, one of the challenges for the market, I did a blog on this. If you want more information, definitely go to our website and look up something I put out last week. But what I wanted to highlight here is the black line at the bottom of this chart is what's called US forward earnings. And it's a weighted average of expected earnings for 2020 and 2021. And as you can see, analysts have been shaving their expectations for earnings in 2020, which is the orange line, and the grey line in 2021. And as they pull those down, forward earnings gets dragged down. And if the market doesn't go anywhere, the price to forward earnings ratio of the market actually goes up. So that's the challenge. If earnings fall and the market doesn't fall, then the PE ratio goes up. As you can see, that the analysts have been dragging down their expected earnings over the last few months, such that the market fall that we've had since the peak has now broadly matched the decline in earnings, such that the price to earnings ratio for the US market, would you believe, is close to where it was before the market decline happened. So the market is trading at a price to earnings ratio of about 18.5. Now, I've penciled in what I think will happen to earnings over the next few months. I still think analysts have got to really shave back their expected earnings for 2020, and that will also drag down the level of earnings expected for 2021. You can still have an expected growth in earnings in 2021, but it will come from a lower base, given that the level of earnings in 2020 is still going to come down. So the bottom line of all that, if I'm right and forward earnings end up dropping to, say, around about 120 on the index by August, the market at current levels will need to trade at a PE ratio of as high as 25 times earnings, which is enormous. That's a ratio that we haven't seen since the dot-com bubble in 1999, 2000. So there is the challenge for the markets. Will it be able to look through that slump in earnings over the next few months and not only hold its, people are still saying the market can push higher. Well, even if it doesn't go up from here, the market is going to be trading at 25 times earnings, if I'm right, and the earnings downgrades continue to come through. So that is a challenge. Anything other than an incredible V-shaped recovery in the US economy will have the market vulnerable to a pullback, given that outlook. Now, what has the market been doing in the interim? Look, one of the benefits of the US market in particular is the tech sector. And again, it just so happens that the most important sector in the US market, and the one that was the lead sector during the bull market, being the technology sector, is least affected by the shutdown. So Netflix, Google, Amazon to some extent. And as you can see, they've held up relatively well than the rest of the market. But again, the challenge is the top 5 companies in the S&P 500 now is at basically 1/5 of the S&P 500's market cap is accounted for by those top 5 technology companies. So people are trying to shelter in that tech area. Now, again, if we do get anything less than a V-shaped recovery and consumer spending remains weak and advertising is cut, the earnings for these companies is going to fall as well. And so that's a bit of a vulnerability for the market. The other point I just mentioned is that bond yields haven't really rebounded in a big way. So those counting on a V-shaped recovery, you're not getting much of a signal of that from the bond market. So there's US 10-year government bond yields. As of this chart, still only around 0.6%, so still sub 1%. Bond market's usually pretty good at sniffing out an economic rebound, and if the bond market seriously thought a strong rebound was coming, you would have seen bond yields somewhat higher than they are at the moment. Credit spreads, the Federal Reserve has done a good job, I guess. Well, some people say it's a bad job because it's encouraging moral hazard, but it's jumped into the bond market. It's been providing some source of liquidity to the bond market. So credit spreads in the US have narrowed, but they still remain quite wide relative to what we had at the start of the year. One thing to watch, just to conclude, in terms of the markets, is the gold. And again, gold has been holding up pretty well as a safe haven. And again, this is one where I think if the markets do sell off over the next few months, gold may well remain a safe haven, because it means that bond yields are going to stay very, very low, and the banks will still be, flooding markets with liquidity. And even in a rebound in 2021, if we see central banks keeping rates very, very low, you may see gold continue to strengthen and maybe the US dollar weaken next year. So, there's various scenarios under which gold can continue to do well here. So just something to, maybe think about as a defensive, well, as a different type of asset class exposure, given the very unique circumstances. So that's really just to conclude with those scenarios. And again, regular attendees of the webinar will have seen this before. The U, what are the, I'm still in this, and what does the U-shaped recovery mean? What does it essentially mean? Well, Q2 GDP, incredibly weak, everybody knows that. You may get a positive bounce back in Q3 GDP, but only in a mechanical sense, and thereafter the GDP will be positive, but not by a big margin, and then in Q4 still fairly muted growth, and that is a V-shaped recovery. In which case, the earnings numbers are going to have to be cut by a lot, and there'll be a lot of uncertainty. And again, the other issue is that we got to, even as we're seeing in Australia, the lockdowns, there's talk of easing the lockdowns, but they're not going to be fully removed. Even in the US, it's going to take a while. And, I think Treasury Secretary Mnuchin was overnight saying he thinks by the end of August, things could be back to normal. Now, August is a long time away for social distancing and the restrictions in place to remain. And that would just absolutely be devastating to the corporate earnings outlook if it did take until August. The other thing the US needs to watch out for, of course, is it's going into the summer season now, so the rate of infection may well die down. But as the CDC director in the US said somewhat controversially overnight, and Donald Trump has criticised, well, said he was misquoted, but he said there is a very big risk of the coronavirus coming back again in the winter months. So the US may not be out of this, and there's always a risk of it returning when the US moves back into its winter period. So there's a lot of uncertainty in the markets, and the markets at this stage are pricing in a V-shaped recovery in the face of what I think will still be a very uncertain period ahead. So that's sort of the U scenario as distinct from the V scenario. The V, the best hope would be a drug treatment available very, very soon, but that still looks unlikely. And the L scenario, is the worst case where, the US does get a second wave, or other countries do get second waves, and we have to go back into lockdown again. And we may actually get repeat lockdowns every 6 months or so until such time as a vaccine becomes available. That would be absolutely worst case scenario. But my sort of central case is still this sort of U. As a result, I think markets probably will at least retest the lows, if not go down to new lows at some stage over the next few months. With that, I'll hand over to my colleague.
Thank you, David. Thank you, David. So yes, just looking at a couple of investment scenarios here, just to match those. And as David mentioned, our view is probably that the U-shaped recovery is the most likely of the three. So looking at a couple of strategies which may be best suited to that U-shaped recovery, high quality companies in your equity space. You often get a flight to quality in times of uncertainty. Companies with high profitability, low debt can often outperform in these sorts of scenarios. So for those investors looking to up their exposure to that quality factor, we have an ETF QLTY, which gives access to 150 high quality global companies. Then looking at in the income space, the hybrids market can be a great alternative to equities for income. Yields have been in similar territory to bank counterparts, and particularly with talk of dividend cuts across the board, hybrids can offer some income in your portfolio, but have historically provided much lower volatility. We have an actively managed Australian hybrids fund available through the ticker HBRD. For those people looking at the other scenarios, so your V-shaped recovery and looking to buy the dip, Australian equities is an obvious one in many people's portfolios. One thing that you can control in what is quite an uncertain time is your costs. So BetaShares, we have the lowest cost Australian equities ETF in the world. That is available through the ticker A200 and is only 0.07% per annum. The technology space, as David mentioned, has held up very well. Our brand new exposure in the Australian space is the Australian Technology ETF. Now that is available with the ticker ATEC, ATEC. And the NASDAQ 100 on the US side of things, I'm sure many of you are aware of, that is available through NDQ and has done very well through the slowdown, holding those technology names. Your Netflix, your Googles, I mean, companies that have actually seen record subscribership, particularly Netflix there. And for anyone who's looking to make more efficient use of their capital and interested in gearing, we have two geared products which are across the US market. So the S&P 500 is the US market, which is also currency hedged, GGUS, and GEAR, GEAR for the Australian market. And for those looking to protect against an L-shaped scenario or hedge portfolios, or even just diversify further, we have a large range of products that will help you do that. The short suite, as a lot of people have seen recently, upping your weight to cash through our AAA fund. Gold, as we mentioned, and we'll mention again, long duration government bonds, and strategies with a risk management overlay, so looking to reduce overall portfolio volatility. So a huge range of products for any kind of scenario. Highly recommend that you hop on the website. Each fund page has a lot of information about each strategy, so we'll enable you to make your further decisions there. So the question we're being asked a lot at the moment is, where are you seeing flows? What are your most popular funds? Where are people looking at the moment? Before I sort of go into that, I think it's worth actually just noting the overall increase in trading volumes in the Australian ETF market through the month of March. In the times of uncertainty, we've had a huge amount of volume in the Australian ETF market. Investors just hopping in, they like the diversification, the low cost, the liquidity, all of these benefits which have enabled them to construct their portfolios through very uncertain time. So smashing all records in March, we had $18 billion transacted in ETFs through March, a previous record much, much lower than that. Individual strategies and where we're seeing flows. Australian equities has led the board across the industry. As I mentioned, if you're concerned about the uncertainty, if you're worried about stock-specific risk, but still need to maintain your Australian equity exposure, whether it's for growth or whether it's for income, one of the only things you can really control is your cost. So purchasing a large diversified ETF at the lowest cost possible can have some benefits. As I've mentioned, A200 is the cheapest on the market by a significant margin, and this chart here just shows the differences between other options on the market. So a lot of flow going into those broad equity ETFs at the moment. And quality, as I mentioned, now this chart is an interesting one. It shows the quality index through the global financial crisis is the primary bit of the chart you can see there. And quality companies experience much lower drawdowns, but in this case, their recovery was much quicker as well. So the quality companies being that orange shaded area, and the MSCI World, so the broad global market, the gray. And you saw a maximum drawdown of quality of 23%, so negative 23% from peak to trough, whereas the broader market was down 42%. So protecting on the downside, but you see that time to recovery as well. So, and that has run true again. The quality companies and quality has held up very, very well in the recent, so this year, as you've had secular growth, so companies which have been able to offer dependable, regular growth in a low growth environment have continued to do well ever since the global financial crisis, and as bond yields have been decreasing. So a lot of people looking at that quality factor at the moment and continuing to do well. And as David mentioned, one area that is probably topping the charts for inquiries at the moment is questions around oil and the oil price. So the cost of storage at the moment is astronomical. In the US, as we'd have seen the news, you had negative oil prices for the first time in history. And whilst these low oil prices might sound attractive to investors as an entry point, it is extremely important to bear in mind the cost of holding these exposures. They have to get, because we can't take physical delivery of the oil, we have to roll through futures contracts, and that can come with a cost at the moment because it essentially builds in that cost of storage. If there's nowhere to store the oil, that cost is extremely high, and you can see here when this chart was taken, so it was, you would need an oil price rise of 27% to break even from when you rolled from one contract to the other. Now, we have a lot of articles on our website. I highly recommend that everyone reads if they are looking at an investment in oil. However, an alternative, which we remain extremely positive on, is energy companies. So the large global energy companies, you know, Exxon, Chevron, BP, Total, these are your big oil super majors, have extremely good balance sheets at the moment, are there to take over all of the small shale providers who are struggling with these low oil prices and may go bankrupt. They're well positioned to take over those with much more increased efficiency. And if you have a look at this chart here, you can see the orange line is our fuel ETF, so that's our global energy companies ETF, and the NAV per unit is on the right-hand column, or the right-hand axis, and that is the movement in that price. And then the gray line is Brent crude oil prices, and you can see a very, very high correlation between those two. So for investors looking for a global recovery, and it, like a stop to this glut in oil, or at least an increase in the use of demand of oil, energy companies can be a much simpler way to gain that exposure. So you can access that through our global energy companies, FUEL. That is currency hedged as well. And finally, we touched on it, but gold. Gold is continuing to be a large demand builder in our suite. So for those who are looking at a longer term view on gold and think it's constructive, what we found, and looking at this chart here, the orange line is a currency hedged gold exposure. So when gold is in a positive run, it's typically highly correlated to the Australian dollar. So if you bought and gold is priced in US dollars. So if you bought an unhedged gold exposure and the Australian dollar is rising versus the US dollar, that can work against you. And you can see that in the light gray line, that is an unhedged. So when gold prices are rising hard, the US dollar can be falling, and that can be a headwind to your exposure. So for people with a constructive view on gold, there is the potential to look at a currency hedged gold exposure. The chart also includes the ASX 200 there, just as a reference, and you can see that negative correlation between gold and the ASX 200 at certain points in time. But it is just a really good uncorrelated diversifier to add to portfolios if you're looking to diversify a bit further. That'll probably conclude a few of the investment ideas there. As we mentioned, things to consider, risks with all of your investments. Do your research, speak to a financial advisor. And we'll open it up to questions. So we've had a couple of questions here. And this one might be for you, Dave. So someone just asking about how will the oil glut affect Australian gas stocks? I don't know if you have any views on how that might have implications. Okay, well, we seem to have lost Dave there.
Yeah, no, I'm here. Can you hear me now?
Yes, absolutely.
Sorry, can you just repeat the question?
Yes, Dave. So we have a question here just asking about the current oil glut. Will that have any effect on Australia's gas companies, do you feel, or how that might affect Australia?
Well, I mean, well, I mean, it's obviously not great for gas per se because the overall energy market is oversupplied. So, you know, weak oil prices tend to lead to, you know, weakness of in the competing products as well. So it's not, you know, I think especially great news. You know, any energy producer at the moment not benefiting from the weakness of global demand. But I think, you know, the energy scene, some of the major companies are pretty well placed to withstand this. And, you know, so a bit like our fuel ETF, I think some of the major stronger companies that can get through this crisis, and some of the smaller, more marginal players are basically forced out of the industry, they'll be left in a stronger position.
Yep, absolutely. One thing I might add there is when we're talking about the oil glut, this has been very, very centered around the US from a supply side basis. Now, obviously, global demand is extremely low. Nobody's flying, nobody's driving, no one's really producing and using oil. But the oversupply and the difficulty of storage is at extreme levels in the US. If you compare Brent crude oil, which is done in the North Sea, getting it onto oil tankers has been less of a problem. Oil prices are still struggling, but when you're drilling it out of the center of the US and trying to transport that to the coast, which is where most oil over the long term is stored, that is where this glut is happening. So specifically from a supply side, probably has less of an impact to the Australian gas producers, but as David mentioned, there's correlation between all of these and can put some downward pressure on all energy at the moment, particularly from a demand side. Another question on OOO and is looking at obviously where we are with crude oil prices at the moment, close to $10, but futures contracts looking at later dates higher prices, what is our view on O at the moment? And really, the key thing with this is, whilst futures contracts might be higher in the future, naturally, you do have to consider the cost of rolling from the current month to the next one. So just because that futures contract is higher, you've got that cost of rolling, and that contract will erode to the current spot price at delivery, assuming no change in oil prices. So in order for a positive view on oil, we'd say you need a large increase in demand. Even if they turn off the taps and stop producing oil, you need a large recovery in demand, and then that cost of storage needs to dissipate. So at the moment, look, there are a lot of moving parts in gaining a futures oil exposure. It's very complicated. We'd highly recommend that people do a lot of reading. And I'll hand over to Dave there.
Sorry, Alistair, I was just going to say, maybe another way just to think about the oil market and whether to buy O or not. I mean, one way to think about this is like there is a futures curve. I mean, as Alistair mentioned, there's a futures curve. So the markets already have expectations of where they think oil prices will be over the next few months. That's already effectively priced into the market. So when you buy O, you've got to take a view that you think oil prices will rise by more than what's already priced into the market. So you've got to look at like the June, December contracts. And if you for whatever reason you think oil prices will be higher than what is currently priced into the market, then you can buy O. But if so that's just to reiterate what Alistair mentioned. If oil prices appear incredibly low and unsustainably low, the market's not silly. They will price in some sort of recovery into the futures curve, and that's effectively what you're betting against when you buy something like O. And even in a neutral environment, because it's storing oil costs money, then you've got to basically wear that cost, by simply holding a position in oil, even if it doesn't go anywhere. In a sense, there's a natural erosion from you're paying the cost of storage effectively. But the bigger, I guess, the simpler way to think about it is the market's always got some expectation of where it thinks oil prices will be going in the future, and you've got to basically come up with a view. Do you think prices will rise by more or less than what is currently priced into the market? Is that fair enough, Alistair?
Yeah, absolutely. I think that sums it up perfectly. Gives a really good overview for anyone looking. So just be aware of those. Another interesting question. People asking, will the withdrawal of super funds, will that have a large effect on the market due to the current rules? No,
look,
I don't know.
It's hard to say, to be honest. It's hard to say. The evidence is, look, I don't think it will have an impact on the overall market. I think the size of the flows would still be relatively small given compared to the total, market capitalization. But it may be an issue for some. I mean, it's for some industry funds which have invested in illiquid infrastructure assets that that poses a risk. But most of them are saying that they have sufficient cash and other liquid assets that they can sell to meet those redemptions. But it is a big unknown. I mean, we'll have to wait and see in terms of how much people do avail themselves of that opportunity. It is also interesting that some of the industry super funds that have the most illiquid type of holdings are the ones that do cater to relatively lower income workers, the hospitality area and whatnot, who are more likely to tap into their super. So it is an issue, but look, in terms of the overall market, I don't think it's going to be the big driver. The big driver ultimately is just going to be the fate of the global economy and the US economy in particular, rather than the size of these flows.
Great. Actually, I had an interesting question. Well, it's a very fair question, and probably worth touching on is actually just a very quick overview in terms of the differences between a VU and L-shaped recovery. What they may mean in sort of very simple terms. So a V-shaped recovery really. Hello? Yeah. So a V-shaped recovery really means that we're looking at a sharp rebound in markets and a quick recovery. A U-shape will mean that we have a delayed recovery and markets will stay sort of flatter and lower for longer and then may recover, and L-shaped looking at a very, very slow recovery. So just highlighting those very quickly for people. We've got a very large number of questions here. So anyone that we do not answer, we will send you an answer to your question privately over email. We are very conscious of people's time. So I think we have taken up 50 minutes. One thing we will do is share those poll results, and I said we did have a resounding answer that a U-shaped recovery is the most likely. So thank you very much for taking part in that. And we have a number of webinars coming up in the future. The next one we will have is on our ETF masterclass. So looking at how you can best trade ETFs and best practice there. So thank you all very much for joining us, and thank you for your questions. We will answer any that we were unable to answer straight away. Thank you very much.
Thanks, everybody.